Something that's been transpiring with gold, not just here in the United States, but around the world, to be implemented in some way into monetary, whether it's just regional through BRICS or whatever. The barometer is, to me, is no longer, hey, like we used to be 20, 30 years ago. What's the dollar doing this morning? What's the long bond doing this morning? Don't worry, be happy crowd on Wall Street will be asking in months, hey, what's gold doing this morning?
We're going to do a Q1 assessment of everything that's been happening in the markets up until now. What is still a good investment? What could be out? Peter Grandich, founder of Peter Grandich and Company, is here with us to discuss his outlook for the markets and the economy. Peter, it's always good to see you. An honor to have you back again. Thank you for being here.
Always a pleasure, David.
Gold has done well. Stocks have not done well. The 10-year yield rose unexpectedly on April 2nd when Trump announced Liberation Day and enacted a bunch of retaliatory tariffs. Let's do a recap before we talk about what's next. What, if anything, has surprised you so far with the way markets have behaved up until now?
Not very surprised, David. I took a very bearish position after the election on the belief that a short-term rally would last on the enthusiasm of Trump, but come what I call Coronation Day, or everybody else called Inauguration Day. I thought he was taking too hard of a stance in his talk about trade, which he implied. I think it's backfired on him. I think the reason we're seeing this counter trend rally that I talked about early yesterday morning occurring is because people believe it's relief. It might not be as severe as it appeared a few days ago, but I think he lost a lot of political playing cards, not just on the trade front, but on other areas. So I'm not surprised, or maybe the volatility. I'll tell you the one big surprise after now my 42nd year. I never thought I'd turn in any given day and see a stock market down hard, the dollar down hard, and bonds down hard. And of course, gold was up a lot that day because normally when the stock market has a bad day, either bonds or the dollar rally. And that did not happen. And I think that was a bigger signal that we need to focus on in the coming weeks and months because there wasn't the normal safe haven attitude taken by people with money. And I think that's the changing of the guard. And I think it bodes well for gold after this correction that I've spoken about, which appears to finally be underway now in the gold market.
We're going to talk about gold in a lot of detail today. Let's talk about what's going on with the trade war first. This is from Secretary Scott Bessent. The markets were rallying this morning, stock markets, that is, on perhaps the hopes that there could be some sort of resolution between the U.S. and China. This is what Bessent said. Treasury Secretary Scott Bessent on Wednesday said that there is an opportunity for a big deal here. If they want to rebalance, let's do it. This is an incredible opportunity. I think if Bridgewater founder Ray Dalio were to write something, he could call it a beautiful rebalancing. The IMF and World Bank have enduring value, but mission creep has knocked these institutions off course. Anyway, let's talk about China and the U.S. Last week, Trump has imposed new tariffs on China. Some items up to as high as 245%, but everything else 145%. I think China stopped adding numbers, calling these numbers already pointless. But now it's looking like the U.S. wants to negotiate a deal. Are we close to negotiating a deal, you think? Is that what it looks like?
Well, I think from a cards playing standpoint, I think the Chinese have recognized one or more tells on Trump and they have not blinked themselves. And I think the Secretary Treasurer is trying to mop up some from the incredibly too harsh stance that Trump took, expecting that the world would just cave moments after he would impose these harsh tariff requests. Whether they were justifiable or not is not really important anymore. It's the fact that they didn't, and he, in a sense, put himself in a much weaker position to ever conclude whatever this ends up being. And I'll just say this, as you know, this is very important for my work. A few years ago, the reason I got so bullish on gold, one of the main reasons was the belief that the BRICS would turn into a very formidable world trading organization with the United States outside looking in. And I can just say that after what I've seen here, who's ever in charge of new membership at the BRIC has to be smiling from ear to ear, because I think more countries versus less are going to want to be involved with BRICS now, basically how they saw how America behaved in all of this.
Well, what do you make of the U.S. dollar decline, the DXY falling? What is that a signal of?
Well, that's the signal again that the United States days of uh, world leader, whatever terminology you want to use, is shrinking, if not gone. And the very fact that uh, none of the countries of any size rushed and begged for forgiveness. And quite frankly, he caved. And there's another fallout from this, Dave. It's not going to be seen in a matter of hours or days, but in the coming weeks. And that's his political strength here. We're already seeing some of the strong MAGA supporters. Now, I'm neither a MAGA supporter or a Trump hater, so I'm not liked by either side. But one of the things we're already noticing is questioning not only this action on the trade, but other things that were spoken about that they feel he's not acting on. So he's lost playing cards in this, and no matter how it eventually settles here, I think this is beneficial to countries outside the U.S. and not to the U.S. And it's one of the reasons why I don't have any exposure to general U.S. stocks other than those related to resources, and why I still believe places like China, Asia, Singapore, some other countries, particularly in Asia, are more attractive to me than the United States is.
Would you be a buyer or would you go long on the US dollar and dollar equivalents now that the DXY has plummeted so far already?
Well, the dollar got to a point of a critical support level and extremely oversold. Same could be said for the S&P and the bonds, and that's why yesterday morning I called for this significant counter trend rally. I don't think it's going to last very long. I think the dollar eventually breaks that support. And on the dollar index, it gets down to the 89.90 area. So there's still another 10% or more decline in my eyes for the US dollar sometime later in the year.
Do you think that this presents an opportunity for not just gold, we'll talk about gold, but other dollar equivalents or substitutes? In other words, other currencies, perhaps? Would you see capital flows into the euro or yen or any other BRICS currencies, especially given that we saw yields rise and the dollar fall at the same time, which is a bizarre circumstance, but it happened.
The world has woken up, still not so much here in North America, to the ultimate currency, and that's gold.
Hmm.
And while it got very overextended, as I noted yesterday morning in a special alert to my clients, that we were at the highest technical bearish levels of MAC, and the price of gold was 25% higher than its 200-day moving average. That was screaming for a correction. But the very fact that the physical demand for gold now is so widespread and increasing and moving where it used to be the dollar and bonds, I think what we're realizing is that there's a different part of the world, which tends to be in the East, where more of the economic growth and power goes to and is increasing. And they recognize gold as the ultimate currency and not the dollar or the yen or anything of that nature. And once this corrective phase for gold is over, and it could correct 10 or 20% from its high, but nevertheless, I still think eventually it'd be a lot higher than the ultimate high that it had just the other day.
So the ultimate high being 3,400 something dollars. What is the next price level for you? How much higher could it get?
Well, here's the story that I need to tell to answer that question, David. And it's an important story
Yeah.
because it affects other markets. When I entered the business 40 something years ago, the Dow Jones Industrial Average traded between 700 and 1,000 for 12 years. In the early 1980s, people were so bearish on the equity market that Business Week ran a famous magazine cover and said equities are dead. And a young man out of Gainesville, Georgia, that no one heard of beforehand came out named Robert Prechter Jr. and predicted 3,600 on the Dow. And he came up with this new relative technical analysis that no one knew about at the time either, called Elliott wave theory. And people scoffed. They laughed, even on the national financial networks at the time, which was basically just Wall Street Week on Channel 13, on public broadcasting. And of course, we ended up going much higher than 3,600. I'm not saying that gold's going to 36,000 or 40,000. What I think you got to realize is that things swing in pendulums, and the stock market from that point to most recently swung dramatically 180 degrees, and things tend to swing back the other way as well. So I don't think there's a number that you can say that's too expensive for gold. It's relative to everything else that is happening. And the United States is also doing something about gold that we don't know yet, but there's too many hints, especially from the Secretary of Treasury. I have a lot of respect for, by the way. I think he has a fairly sound mind, and I think the president would be better served listening more to him than Ludnick and a few of his other more hawkish kind of wild thinkers in his group. But he is continuing to speak about gold in a way that it would not surprise me that the United States is going to use gold somehow to better itself economically, whether it's just repricing it so it frees up opportunity to borrow more money, or introduce some sort of gold backed bond in order to attract much bigger capital and not have to pay a lot of high interest rates. But the gold market is just seeing the first leg of a huge bull market that needs a correction. But I still think someday the price will be a lot higher than 34 or 3,500.
Central banks are still buying gold. I've been reading the news. So clearly, central banks are price sensitive. That's one indicator that perhaps central banks don't think that gold is way, way overbought. Otherwise, they wouldn't be buying now, would they? Unless they don't really care about the price and they just buy
Well,
whenever it's strategically important. Yeah.
Dave, you're hitting right on the key. Why have these central banks taken such a massive position and on top of it, repatriate their gold to the point of 33 or 34 different central banks? They don't have the ability to flip it to somebody and sell and lock in the profit. They're acquiring this gold for something that's going to be related to some change in monetary, whether it's regional or worldwide, and that's their reason. And so and it's going to surprise people one day to realize that places like China hold a lot more gold than their noted reserves. And what was really interesting is, despite a move extremely fast from under 2,000 to 3,500, that central bank buying not only didn't dry up, it began to be even more constant and strong. So I think there's still a lot of room for the gold market, but it was so overbought and so in need of a healthy and necessary correction. But I think they'll be regular buyers for weeks, months, if not years in front of us.
All right, let's flip over to my screen here. Let me show you the GDX. This is the GDX versus the S&P 500. Year to date, it's outperforming. The S&P is down about 10%, and the GDX is up 38%. Let me just refresh this. Yeah, wait. There we go. That's the dollar. Anyway, the gold miners are starting to outperform not just gold, but of course the stock market overall. How are you feeling about the miners? Are you extending the same sentiment to the miners as you did with gold, meaning you're still very bullish even at current levels?
The major producers are legally printing money through the massive free cash flow that we're seeing. And what's going to transpire here is it's going to be very difficult for the S&P 500 to see earnings growth this year. One of the other things we didn't get to talk about is the more and more signs of the economic slowdown that's happening here in the US. So what will happen to the generalists, and most people are followers in the Wall Street, not leaders, they're going to start to see that there's no sectors that they can see good, dependable earnings growth for the foreseeable future, except one: gold producers. It's one of the reasons now we're starting to see not only people buying the stocks, but I think this news that was done with Barrick selling to a basically an investment group, one of their major mines, is another signal of what's to come for gold producers, particularly the companies that are producing the metal. The exploration's another story, and that's still just starting to stick its head out. But I think longer term, the GDX and even the GDXJ have a lot higher price levels to reach before there's any really consideration to any meaningful top.
Well, here's the GDXJ. It's also outperforming, up 43% year to date. I wonder though if right now is a good M&A environment. You think clearly valuations have gone up for these exploration companies because of the gold price going up, but would companies with the large caps be looking at buying things right now with everything a little bit more expensive?
I think there'll be mid-sized producers merging with each other to become larger. I think one of the differences this year will be is because they're a lot better off health wise economically and balance sheet wise. Now, of course, one or two of their biggest expenses is going lower: energy, labor costs. I think we're going to see a lot more strategic investments by the majors into mid-size and especially the juniors. I don't think they're going to go out and get leveraged like they did back in 2010 and 11, which is a good for them, and it's good overall for the markets. So look for more type of strategic investments instead of public doing private placements, the majors doing private placements. I think everything that I'm hearing from the few good exploration companies that have highly advanced projects is that the corporates are knocking heavily on their door now. So I suspect that in the coming weeks, we're going to see more and more of those type of deals.
Okay. Now, are you more inclined to be investing in gold or silver right now, both for metals and the explorers?
So for many years, especially in my days of speaking, including that beautiful town behind you, I got abused by the silver bugs because when I was be bullish on gold, I would say this statement that silver is like kissing your sister. And I always put gold ahead of silver. But a couple of weeks ago, I changed that opinion and I upgraded my view to where I felt silver could be on equal terms with gold. One, because the fundamentals have improved greatly over the years. Two, there's been clearly manipulative forces primed to prevent it over a certain price. And three, the ratio between the gold price and the silver just became to a ridiculous level. And in fact, just a couple of days ago, I said I thought silver could lead gold here. And sure enough, as you and I speak, with gold down over $100, silver's up almost $1, and that is another sign that better days are ahead for it. Now it will be capped somewhat here while gold goes through this corrective phase, but I think now it has all the ingredients to take out that key resistance in the 35, 36 area. And I think we're going to see a much higher silver price later this year, as well as a gold price.
Right, but are you more bullish on silver than gold? I mean, like you said, the gold silver ratio is at multi-year highs over 100. Last time it was this high was during the pandemic, uh, and then right after the gold silver ratio collapsed and silver started
Yeah.
outperforming gold. But that was during Fed quantitative easing, which we're not getting now. So different macro environment. Which do you think will be a leader?
I think they're going to proportionately perform well. I mean, it is
Hmm.
a lot for me to put silver on the same terms of gold. That's not something that historically you'll find in the Grandich track record.
Hmm.
But I do think it warrants the similar interest. And I think a balance between both of them is key. And then, of course, just this is important to note, there's another metal that's doing extremely well. And it was my favorite metal for the year. It's doing a lot better even than I thought it would be at this point, and that's copper. And so between gold, silver, and copper, and even the fact that I became, I put my bullish hat back again on uranium after getting out near the top, I still think the metals as a group still have a ways to go to the upside, that we're not anywhere near other than an intermediate top maybe a few months from now, but there's still a long way to go in these prices. And one of the key reasons, David, is how strong the physical market is now. When we had the big move in gold in the 1980s, and of course in 2010 and 11, it was driven through the paper market. But now physical market is just destroying the paper hangers that used to manipulate the gold price. And that's, as long as we continue seeing physical demand stay constant, the metal should just work higher over time.
This is the copper price. Let me just show people on the screen what you're referring to. There was a big decline in the price right after Liberation Day, which is when Trump announced the tariffs on the 2nd of April, and then it's recovered most of its losses, not all, but most of its losses since late March. Is this what you're talking about, the rebound here? And by the way, why is it rebounding? Is it Dr. Copper has usually been a fairly consistent indicator of growth, or at least growth expectations. The fact that it's rebounding could signal that the copper market, the commodity market, doesn't believe these tariffs are here to last. That's my interpretation. How are you reading it?
So Dr. Copper should be put on the same shelf with the word transitory, because copper market used to be amply supplied. And when there was a strong economic period, people bought it. And then as soon as the economy slowed down, hey, there's a lot of copper out there. It's going to come down. And it did. That's not the case anymore. This is a market that has seen almost worldwide neglect in terms of trying to find bigger, more worthy deposits. Grades have shrunk dramatically. Cost to get up those type of grades has gone up a lot. And then combine that with a lot of places in the world you no longer want to go to politically, socially, economically, and all. And so what's happening is, despite supposedly a slowdown worldwide and fear of that, copper rises. And that's because the people that turn it into and put it out are having difficulty getting supply.
Hmm.
And so it just has very, very bullish indications. And quite frankly, you're going to need a price substantially above five before companies are going to invest billions of dollars to go out and develop, because copper tends to be a highly intensively high cost product to find. And that's why the companies now, David, and this is important for your viewers, that have a good copper gold mix in them are going to get big premiums. And that's why the Barracks and all are switching to copper gold type projects. So if your company has copper and gold significant in it, it's going to get a premium versus if it was just gold or just copper.
If you're bullish in copper, are you also thinking that inflation is going to go up? I'm just thinking copper being such an important input into a lot of things. Either companies are going to start thrifting away from copper if it gets more expensive, or they'll just absorb the cost. Everything else will go up. Copper wires will go up. Construction will go up. Everything.
Well, David, I've had trouble, even though this is my 42nd year, trying to find where the government reports inflation up only 2/10 or 3/10% each month. And I look at my own personal bills and everything and anything that I have to buy going up a lot more. So I think inflation is a lot higher than government statistics tell us. But even on that basis, I think any dream of the Fed's facade of two tenths of 1% inflation again is just not going to exist. One, for instance, the tariffs, or eventually these tariffs will come down, but I think costs are going to go up because the de-dollarization and globalization is over. And that was one of the biggest things that helped get us down in inflation. And we're not going to get that cheap labor anymore that helps suppress prices. And therefore, I think inflation will be higher than what people think, and therefore bullish for commodities in general.
You talked about stagflation before. Are you thinking that's still going to happen?
Yeah, I think we have it. I think we're going to see in the coming weeks how weaker the economy has become here in the US, yet the inflation numbers are not going to be dropping that dramatic to support that. And I think that's a word, stagflation, that's going to be used quite a bit in the coming weeks and months.
Do you think it's possible we'll get negative real yields, meaning the nominal yield will be lower than inflation? So the 10-year yield is currently, let me just pull up the 10-year chart. It's currently at 4.36%. So let's assume that the 10-year stays around current levels. If inflation shoots up above 4%, we're looking at negative rates, at least for the long end of the curve.
I think that's possible, but I think the big change in the bond market that your viewers should focus on is there's growing concern of the ability for us to pay our interest payments. That is a legitimate concern now worldwide. And I think if we're talking about reducing deficits and debt, but we're actually going in the opposite direction, continuing. We're facing a huge refinancing of not only treasuries of many trillions of dollars that have to be refinanced in the next 12 to 24 months, but on the corporate bond level, a tremendous amount. So I think it's going to be very difficult for interest rates to go a lot lower. And where that also causes a significant problem continuing is in the real estate market. The affordability of housing, both in Canada and in the United States, the unaffordability index is at record highs. And so all these things are not bullish, and why I still, have this, live chicken versus dead duck approach to investing in general, outside of specific certain types of metals and things of that nature.
The 10-year yield spiking. Let's go back to the bond market here. Treasury market has not done well in April. Do you think that treasuries will continue to underperform gold? In other words, are treasuries no longer the de facto safe haven asset after what happened?
I think what's happened is I think they lost their rightful place as the place to go.
Hmm.
I think there'll still be money parked there. I think it will also be parked closer to more in the T-bill section. I think it's going to be more difficult to finance longer term debt than it will be shorter term debt. Now, understand this. Something has been transpiring, and maybe save this and see if in 6 or 12 months you pull it out that it was worth pulling out. Something has been transpiring with gold, not just here in the United States, but around the world, to be implemented in some way into monetary, whether it's just regional through BRICS or whatever. And that will play a big role then on what happens with bonds and so forth. And so the barometer is, to me, is no longer, hey, like we used to be 20, 30 years ago. What's the dollar doing this morning? What's the long bond doing this morning? I think what a lot of people, even the don't worry, be happy crowd on Wall Street, will be asking in months, hey, what's gold doing this morning? And after, like I said, this corrective phase that was necessary and welcomed, I think gold will start work back to and even reach new highs. I never thought, David, in my career that I'd be talking about legitimately a $5,000 gold price. But I believe that's a legitimate possibility now. And that really, if we're at 5,000, that doesn't suggest to me that a lot of good things happen for the dollar or the bond market.
Well, let's just do the math. Your 5,000 divided by what are we currently at? 3,400. That's a 47% increase, which is what we saw in 2024. So all the gold market needs to do is repeat 2024 and we're at 5,000. I mean, it's a big assumption, but it's not like it's unprecedented at this point. So, another question I have for you is how people should react during what we saw in 2025 for the equities markets. Now, you've lived through a lot of bear markets and crashes. You were on Wall Street a few decades ago, and you know what it's like to go through a panic sell, a fire sell situation, which is what we had during 2020, which is what we had during 2008. 1987 was another example. 2001, right? Tech bubble burst. This isn't on the same scale, but a lot of people were panicking, especially in the middle of April 2nd, April 3rd, huge drawdown. But overall, the 2025 market has been not great for stocks. We're officially in a bear market, down 20% if you count the lows in early April. What should people do on a day like April 2nd when we have a massive drawdown in stocks? What? Give us some wisdom here, Peter. How do we react?
Well, I just believe that we've been basically used to or have an industry professionals who believe basically investing is a one-way street. Yeah, there's these terrible relative short term to the longer picture, sharp declines, but hey, the stock market always comes back. And it always comes back because the Fed can always do something to help it come back. I think the difference this time around is that's in question. And I think the issues now are far greater and going to be more challenging to always have the belief it always comes back. And so, what I think people need to be concerned about is it's not so much if it's going to crash, but what if it doesn't keep going up? Even if a market is flat to somewhat lower, not a lot. There are so many people in my financial planning group that I still see today that are living on expectations of much higher returns because of what they've gotten used to. And if they don't get them, their lifestyle is going to take a big hit. And so I think the big concern is can you come up with reasons that the stock market can still grow by 10 or 20% a year over the next 3 to 5 years? I don't see the economic, social, or political aspects that are going to allow something like that. And so whether or not it's going to crash isn't important. What if it just doesn't keep going up? How does that impact everybody? And I think it impacts a lot of people in a quite of a negative way. There was a statistic, if I may, Dave, people should know this both in Canada and the US. And the Secretary Treasurer came out with it. And I like this guy a lot. I think he's very sharp economically wise. He brought out a very good point that the richest 10% of Americans own 86% of the assets. And the next 40% own the remaining 14%, which means half of America doesn't own any assets. They're basically in debt. So one of the things I think we need to do, all of us as financial people, is we need to watch what's happening and what are those top 10% doing, because they're the ones that are going to have the most effect on what happens to asset prices. And what's real interesting is in recent times, even before 2025 started in 2024, the very extremely wealthy have been moving away from US assets and moving away from equity, especially. And so I think that's an important part that a lot of people don't talk about is focus on the very rich, because they're the folks that own most of the cards. And right now, they are not bullish. We've seen Jamie Dimon selling a lot of his stock. We've seen a lot of people of wealth moving out of their own company stock. And I think that's another indication. All that's why I think things are going to be a lot more challenging, Dave, than some of the more bullish people that are, working on Wall Street.
Let's say I'm a relatively new investor. I got burned in early April or even just throughout the year. And I'm expecting things to not be as calm as they used to be last year. And now I'm wanting to hedge against any future volatility. Of course, I don't know when it's going to come. I don't know when the next flash crash is going to happen. But now you know, I've been burned once, not again. I don't want the same thing to happen. What should I do to protect myself or to prepare
Well,
myself?
Well, first of all, I don't believe most investors, and I was guilty of this in my early years. And I know the financial service industry in the US, I can't speak for the one in Canada,
Mm.
does a poor job on this overall. We don't realize the potential mental anguish we can cause people if things don't go right. There are a lot of good people that do good financial planning and understand finances, but they don't understand what it would be like for a client to lose money and then how it impacts their life, because a lot of people in the financial service business are among those very wealthy people that we talk about and don't face the same things that the average daily person working. I think we have to look at how did we feel during that decline. You talked, the example of this was somebody just experienced it and they lost money. If your life changes and you're not living it the way that you normally do if the market isn't falling, then the market isn't for you. That's what you just have to accept. I used to watch some of the wealthiest people, especially the athletes I deal with, who did phenomenal in other places, but they wanted to trade futures or options and they would get their head handed to them. And I say, why do you do it? Well, my friends are doing it and I want to be like them. Do what you do best. And if the markets cause you inability to live your life out, this great life that we get, it's a phenomenal opportunity, this gift, because we don't have any control either of our next breath, then I think you need to start thinking and start measuring how much mental tolerance, not how much financial risk I can just take, but how much mental aspect of all of this can I take?
Are there, let's say, any assets that people should use as diversifiers or hedges, should we say? Gold is a clear winner for the reasons you've stated earlier. Anything else? What about real estate? What about, alternative assets?
Well, I'm a big believer in being debt free. It's been something that I've championed in my work for half my career. And the reason is when you pay in something 7, 8, or 9 or 10%, if you look at what the total cost when you end up owning a home versus what you think you paid for it, the first thing is if you can work and get out of debt, that's an investment in itself. We're watching people in the United States now paying as much as 20 or 25% because of poor credit on their credit cards interest. So getting out of debt or not having debt suppress your opportunity to make money. Then, of course, a golden rule of mine, Dave, and is you got to spend less than you make. So whatever you're making, you have to spend less. And those two things should be first priority before thinking about anything about gold or any other investment. Now, if you get past that, I think it's important now to keep cash uh, as a significant holding, because it's more about capital protection now than it is capital appreciation, as far as I'm concerned, across the board. And so you should focus more about preserving what you have and the purchasing power of it versus trying to turn what you have into multiples higher.
Okay, good. Well, that's sage advice as always. Thank you very much. Peter, good to hear from you again. Where can we learn more from you and follow you?
Well, most of my commenting is on my X page, but there is also a YouTube channel, and then there's petergrandich.com for any other information about me.
Anything, let's close off here. Anything that you're least bullish on, or perhaps more bearish on for the rest of the year? We know you
We
like the
had
metals, but anything
we
else?
had such a good interview. Why do you have to close it with that question? Because now I have to answer it. It's only going to create hundreds of comments in your
Oh, there
section,
we go.
asking emails to me. But I'm going to answer it because you asked me a question. I told you from day one, I will always answer your questions to the
Sure.
best of my ability. I am not a believer in general cryptos, including Bitcoin, just like NFT and NFFs have
NFTs,
gone to
yeah.
zero. I believe mem coins are going to zero, and I think a lot of the cryptos are overpriced. There will be a survival. I don't think it's Bitcoin. I think too much emphasis. I think it's going through a major topping formation, and it's not a place where I suggest to any of my clients to have any real assets in. So now all those people can make their comments uh, and send me some of those beautiful emails that I get. But I answered your question legitimately and honestly.
Well, some people might agree with you, Peter, so I don't think you'll get a lot of hate mail. But just because you talked about Bitcoin and wanted here, let's say you don't know anything about Bitcoin, and I'm going to present to you this chart. Recently, it's been kind of diverging from the Nasdaq, which it has traditionally followed. So the Nasdaq's gone down, and except for today, they've kind of moved in opposite directions. Bitcoin's been moving up. Some of it has to do with the dollar depreciating, and of course, if it's priced in dollars, it's going to go up. But it's kind of been following gold. And if someone were to make the argument, well, if you just look at the chart and not the fundamentals of what Bitcoin and gold are, you can see that these two assets are starting to trade more in line with each other as the dollar falls. Perhaps it's just another digital way to buy gold. How would you respond to that kind of argument?
So I've heard 3 to 5 different reasons over the last 5 to 10 years what Bitcoin is and why you should own it.
Yeah.
In fact, it's ironic now that the original people who were the early people and made a lot of money in it are really the people that hate what they hear now about it because it's been turned into something that the original believers and supporters said that that's the reason you don't want to own it because it shouldn't be doing that. But having said all that, I also find it quite interesting now that after 3 or 5 years ago, when gold was 1,500 to 2,000, and the biggest spokesperson for Bitcoin was telling you that gold was a relic, useless, you don't want to own it, put your money in Bitcoin. Now it's at least trying to compare itself to say it's like gold. It's not like gold. And it's not like anything else. It's a highly speculative. Hopefully, you're not the last person that pays the highest price because that's the only other thing you can do with it. It's not being used. It's trying to be created into it. Went into all this stuff. It was going to be a reserve currency. It was going to be all of this. It is a highly technology stock, and that's why it performed with the Nasdaq. And if the tech bubble is over, so is the bubble over for cryptocurrencies, in my opinion. And if that doesn't generate enough hate mail, David, nothing will.
I can think of worse things to say on here. I think you've been very diplomatic. Thank you very much, Peter. Once again, follow Peter Grandich in the links down below on his social media and his website. And we'll see you again next time, Peter. See you soon. Thank you.
It was a pleasure. Thank you, my friend. God bless you.
Pleasure was all mine. And thank you for coming on the show. Thank you for watching. Don't forget to like and subscribe.